When markets go berserk in the latter part of their bull phases, which is quite typical of many markets, they tend to have that acceleration phase. Silver and gold certainly did back in, 1979, 80, then again in 2010, 11. They've been going up for years and suddenly they went vertical quickly. And also at that time, silver tended to sharply outperform gold to the point where you didn't even think it was the same market. It was so vertical. Silver has, I sent you a chart, in fact, a spread relationship with gold that we show going back 50 years, where it shows the peak reading each year, peak monthly close of silver versus gold. So in other words, each year, what was the highest closing ratio of silver to gold? Okay. Now we do it a different way. We divide silver per ounce into an ounce of gold and get it as a percent. Right now we're about 1.13%. Okay. But as you see, going back 50 years, 1974 in fact, that it gets up to 2%, that red line, in 21 of the 50 years. So it's hardly what you'd call abnormal to see silver at 2% of gold. And in fact, during bull trends, for example, back in 1979 and 80, it went up to 6.5% and spent a couple years up there at 4%. Okay. And then in the 2011, 10 and 11 surge, it got over 2%, went up to over 3%. Okay, now, just normal again, right? And again, right now we're 1.13, 1.14%. We've technically analyzed not just silver and gold and their net trends and their momentum, but we analyze the spread. We do it on a daily basis and a monthly basis to see if we can define breakout points that say that this lull that you see in the spread here, where for the last handful of years it's been, 1.5% or so. In the last couple of years, about 1.3%. To analyze when we think that could break out and surge again up to what? A normal of 2%. Okay, and that's a big deal because that's almost a doubling of the current valuation of silver to gold, and it's just getting back to a norm. So if you took gold to $8,000, now why do I throw out that number? Well, we started from $1,050 back in 2015 at the bear low. Well, 8 folds over $8,000, and that would be simply saying, well, gold's going to do the same thing it did a couple times before. So we're not projecting 8,000. In fact, I've got some friends who very thoughtful fundamentalists who think it can go in the 20,000s. Okay, forget that. But right now, we think that this spread is about to turn up. In fact, we've had a short-term indicator as of last week that said it is turning now. And we've got certain other levels not far above that tell us we're going to that 2% again. Well, that's a big move. And these spread moves don't occur with silver and gold going down. They occur when they're going up. Okay, silver simply outpaces. So right now, if somebody, asked me what's the best thing to do this year as far as investments, I would be long silver and I'd be long gold and silver miners relative to gold. Gold's the mama. It's going to lead the way up, but it's not going to lead in performance terms. These two subsets of the monetary metal sector will lead. I think it's the best place to be. And this chart merely reaffirms that, hey, it's no big deal to say we'd go to 2%. And silver went to 2%, it'd be $60. Okay, so obviously gold's not going to sit here if silver goes up. But let's say gold went to 5,000. You do the math. Get 2% of the number. If gold had the normal 8-fold move, and again in 1980 and in 2011, much of that came in the last year of the gold move. Okay. Mm-hmm. So if you do that, then, $8,000, you do the math. What is it? It's $160, something like that, okay. Mm-hmm. So the main point is that silver could vastly beat gold, and it looks like the technicals are ripe for that. Mm-hmm. It's certainly not going down versus gold. It's sat in a range since late 2022, in fact, frankly, at better levels than it was then.
When markets go berserk in the latter stages of a bull market, and we've all seen it, they don't just tiptoe upward. They go vertical, parabolic. It's that late-stage surge where everyone who dismissed it suddenly starts paying attention, and the price action accelerates so fast it leaves most of the crowd behind. We saw this in gold and silver back in 1979 and 1980, again in 2010 and 2011. Years of buildup followed by a near-explosive release of energy. That's not an exaggeration. It's how every one of these cycles behaves. It's a pattern as old as markets themselves. Slow climb, disbelief, resistance, then boom. And where we are right now in 2025, it's looking eerily familiar. Now, when gold and silver go vertical, silver almost always takes the lead. Why? Because silver is the torque play. It's thinner, it's more volatile, and it responds to emotional flows. It's what gold would look like if it drank 3 shots of espresso. And when silver moves, it moves fast. We've been tracking this closely through a key spread ratio I often refer to, the silver to gold ratio expressed not in ounces, but as a percentage. Right now, silver is hovering around 1.13% of the price of gold. What does that mean? It means if gold is trading at $3,000 an ounce, silver is just around $34. That's the current reality. But here's where it gets interesting. If we go back through 50 years of data, we see that silver has reached 2% or higher of gold's price in 21 out of those 50 years. That's not a fluke. That's normal. In fact, during the explosive 1979 to 1980, bull silver reached over 6%, and in the 2010 to 2011 bull market, it climbed over 3%. So when I say silver at 2% of gold is normal, it's not an outlier call. It's what we've already seen, again and again. But the market doesn't care about history, right? It cares about what's happening now. So let's look at where we are. In terms of technicals, my firm momentum structural analysis isn't just looking at raw price. We analyze the momentum trends, the underlying structure of these moves. And guess what? Silver's momentum trend has been tightening for over 2 years, like a coiled spring. We're seeing a breakout formation in the spread ratio that suggests silver is about to begin outperforming gold again, and not just by a little. If we return to the 2% level, just the average high over the past 5 decades, silver would need to nearly double relative to gold. If gold sits at $3,000, that puts silver at $60. And that's just catching up to normal. But the real magic happens if gold continues to move higher, which I expect it will. If gold goes to $5,000, 2% puts silver at $100. If gold hits $8,000, silver could hit $160. And here's the best part. It doesn't need anything unusual to happen. Just a return to historical norms and a continuation of existing momentum. Now let's take a step back and ask, why now? Well, the bond market is broken. Stocks are frothy. Real yields are falling again. Inflation has re-accelerated, with CPI trending upward for 4 straight months. Commodities are rising, 25% plus across the board over the last year. The Fed says they're in control, but their actions say otherwise. They paused rate hikes prematurely. Liquidity is creeping back in. Central banks have been hoarding gold, not because they expect things to stay calm, but because they know what's coming. And yet, silver has barely moved compared to gold. It's lagged, it's slept. But that's exactly what makes it so compelling. The technical setup is one of the cleanest I've seen in years. The fundamentals are lining up. The macro story is undeniable. And the psychology? Well, silver is still being treated like an afterthought. That's classic setup behavior. Now, let's not forget the dual role of silver. It's both a monetary asset and an industrial metal. And we're heading into an age of renewed interest in physical, tangible assets. Industrial demand from solar, EVs, electronics, it's never been higher. And yet the monetary demand has barely begun to stir. Once it does, the 2 demand channels will collide. That's how you get an explosive asymmetry. That's why I'm looking at this silver to gold spread so closely. Because it's not just a technical curiosity, it's a window into how the monetary metal's complex functions during late cycle rotations. If you're an investor looking to position ahead of the move, not chase it later when CNBC is running silver soars to $100 headlines, this is your moment. You don't wait for confirmation when the pattern is already screaming breakout. You move with the trend before the crowd notices. And speaking of the crowd, they're still not in. Retail is largely missing. Institutions haven't rotated yet. The mining stocks haven't even started their sprint. That's how you know this is early. So I'll wrap this first half by saying this. Silver isn't just cheap. It's underowned, misunderstood, and technically ready. The structural shift in the monetary system, the weakening of fiat, the remonetization of gold, the breakdown of trust in the central banking, is all pushing capital into hard assets. Gold is the tip of the spear. Silver is the blade that follows. When silver decides to move, it won't ask for permission. It'll be like the last time, fast, relentless, and emotional. And those who waited will be left saying, I knew I should have.
Various things. One, perception that the stock market is no longer a great risk reward asset. It's now a risk asset. Okay. And once they become aware of that by getting kicked in the shins and then in the gut, as we're seeing, even today as we're speaking, we're getting clobbered again in the stock market. What this shows is simply over since 2020. Remember back in the summer of 2020, we had a big upside move in gold, silver, and the miners. And in that time, gold shot up versus the stock market. Relatively. It got up to a 60% level, meaning the price of an ounce of gold was 60% of the price of the S&P. Okay. And then it pulled back. And since 2021, early 2022, it got down under 40%, like 37.5, and it shot up again and lived mainly around the 45% level, but in a range, technically clear range. Bumped the top of that range at about 47, 48%, about 4 times. It's like a ceiling. Well, last month marginally closed out above it. And this month, intra-month, you're well out above it, which is that last reading. So what it tells us is that technically gold is shifting to an outperform mode versus the S&P. We thought that would occur simultaneous with the breakage in the stock market. So it's not merely a function of gold holding steady and moving up, but the stock market going down as well. Well, that, of course, catches the attention of asset managers if there's another place to be. And they've historically gone to T-bonds and gold, 2000 to 2002, 2007 to 2009, they moved into those assets. Right now, T-bonds are getting a rally, and I think it's largely because of the sense of danger in the stock market. But gold has been outperforming both widely, as you saw in that chart. It's not just the last few months, but last couple of years, it's well off that low. So that indicates there is a shift underlying, even though they're not beating the table about it.
What part of the stock market is, let's say, most fragile at this point? We see this outperformance, and we just went over that chart of gold to the S&P. But what about something like the NASDAQ? NASDAQ has had a lot of speculative money flow into it.
Yeah, it was the leader on the upside. It'll be the leader on the downside. This was the case back in the dot-com period where the S&P dropped 50% between 2000 and 2002. NASDAQ 100 went down 82%. Okay, it had led on the upside, the leader on the downside. The same is true this time. Since 2009, the NASDAQ 100 went up about 18-fold to its highs a couple of months ago. S&P went up about 8-9-fold. So you can double the performance of the S&P.
The fascinating thing about these kinds of late-stage bull markets, especially in commodities like silver and gold, is that when they finally decide to move, they don't ask for permission. They don't warn you. They just go. What we're seeing now in the silver market is precisely the kind of setup that precedes these powerful vertical moves. And I'm not just saying this anecdotally. There's momentum behind it. There's technical evidence. We're watching the spread relationships closely, and silver is starting to flash a very familiar pattern that we've seen in prior bull phases. When silver gets to the end of a long consolidation and starts to rip, like it did in late 1979 and again in 2010, it doesn't just move, it explodes. Now here's what I want viewers and investors to understand. This isn't just about silver going up. This is about silver catching up. Right now, silver is only about 1.13% of the value of an ounce of gold. Let that sink in. Historically, that ratio goes significantly higher during bull markets, often 2%, 3%, or even higher. In fact, over the last 50 years, silver has reached or exceeded 2% in 21 of those years. So what we're talking about isn't some pie-in-the-sky theory, it's the norm. What we've seen for the last few years, silver lagging gold so dramatically, that's the abnormal part. So when that normalcy returns and silver gets revalued back to 2% of gold, you're looking at a near doubling of silver relative to gold, even if gold just stays where it is. But gold isn't going to stay where it is it? Look at what we're dealing with globally. Central bank hoarding of gold reserves, a Federal Reserve that has boxed itself into a corner, and CPI numbers that are accelerating month by month. Commodities are waking up, and gold is leading this move. There's no denying that. We're already pushing toward $3,000 per ounce, and this is just the warm-up act. If gold follows the pattern it set in the past, say an 8-fold move from its bottom in 2015, you're looking at $8,000 gold. Now imagine silver climbing back to 2% of that. That puts silver around $160 per ounce. Let that marinate. We've already seen this before. In the late 70s and again in 2010 to 2011, gold had been grinding higher for years. Then suddenly, silver outperformed gold so aggressively it looked like a completely different asset. It detached from gold's steady climb and just went vertical. That's what these bull markets do in their final phases. They shake off the sleepy sideways grind and wake up with force. They're loud, they're dramatic, and they reward those who were positioned early, not those who chase the move. Now let's talk momentum. We track it structurally, and we've been watching silver's spread momentum relative to gold very closely. Over the last 2 years, that spread has been consolidating. Flat, quiet, boring maybe, but that's often where the biggest opportunities are born. Just last week, we got short-term confirmation that this spread, silver's performance versus gold, is starting to turn up. This isn't retail hype or clickbait headlines. This is momentum talking, and it tends to lead price, not follow it. That means the breakout isn't just likely, it's beginning. I want to be clear here. Silver doesn't go vertical on its own. It does so in the context of gold's strength. Gold leads, silver follows. But once silver gets going, it outpaces gold every time. That's just historical fact. Right now, we think gold is still the mama. It's going to keep moving higher and provide the foundational strength. But silver, the kid, is going to outrun mama on the final stretch. If I had to pick one thing to be long this year, just one, it would be silver. Not only silver itself, but silver miners too. Those names, when this thing catches fire, are going to see leveraged moves. That's not theory. That's what history shows us. And it's not just technicals or history pushing silver, it's real demand. Industrial demand is booming. Solar, EVs, electronics, batteries, silver is critical to all of it. The Silver Institute has already forecast that silver demand will hit a new record this year, especially from industrial sources. Meanwhile, supply has been running deficits year after year. We've had nearly a decade of underinvestment in new production. You combine that with the monetary case for silver, the fact that it's still priced as if it has no monetary role, and the setup becomes undeniable. So what's the risk? Honestly, the biggest risk is being late. The biggest risk is that this thing does what it's done before, wakes up fast, climbs steeply, and leaves the average investor chasing after a train that's already left the station. If you're looking at the charts, the fundamentals, and the global macro environment, and you're still on the fence, let me just say this. Markets don't wait for permission. The move will happen with or without your attention. And by the time the media catches on, by the time CNBC and Bloomberg are running segments on the silver boom, the easy money will already be made. We're seeing a shift, a transfer of wealth from paper to metal, from tech to tangible, from hype to hard assets. It's happening in front of our eyes, and silver, in my opinion, is the most asymmetric trade in the world right now. That doesn't mean it's without volatility. It will swing. But when you've got a coiled spring this tight, it only takes a spark. And with the way gold is moving, that spark is already glowing. So here's the bottom line. Silver is sitting on a launching pad. The fundamentals are aligned. The technicals are screaming. The central banks are hoarding gold. And retail investors are still asleep at the wheel. That's the kind of setup you dream about. And like I always say, bull markets don't reward those who hesitate. They reward those who act with conviction. Be early, be bold, and be ready.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.